Welcome back, everyone. Today, we're diving into a topic that's super crucial for anyone interested in the stock market. It's all about market breadth and why it matters, especially in the context of recent trends. So, let's kick things off with a key factor to gauge the health of equity markets: the breadth of participation by underlying stocks. You know, it's like the foundation of a house. If it's shaky, the whole structure is at risk, right?
Yeah, that makes sense. But what do you mean by breadth? Is it just how many stocks are doing well, or is there more to it?
Great question. So, breadth refers to the number of stocks participating in a market move. For instance, if the S&P 500 is hitting all-time highs, but only a handful of stocks are driving that increase, it's a sign that the market might be on shaky ground. Think of it like a concertif. Only a few musicians are playing well while the rest are off-key. The performance isn't going to be great, right?
I see. So it's like when you go to a concert and the lead singer is amazing, but the backup band is just, not cutting it?
Exactly. And recently, there have been concerns about poor breadth, especially in December, even though stock indices are near all-time highs. Some folks believe that breadth might not be as significant a signal for price as it once was. But ignoring it? That can be risky.
Wait, so if the breadth is poor, does that mean the market could crash or something?
Well, it could indicate a potential shift. For example, recent trends suggest that breadth has anticipated changes in market expectations regarding Federal Reserve accommodation. When breadth declines, it often coincides with rising yields, like we've seen with the 10-year UST yields recently. It's like a warning light on your dashboard if it's flashing. You might want to check under the hood.
Oh wow, that's a good analogy. So, if the yields are rising, does that mean stocks are going to struggle?
Yes, exactly. Rising yields can act as a headwind for stocks. And what's interesting is that many investors are increasingly relying on price momentum in their strategies. It's like they're on a roller coaster, just riding the highs without looking at the safety bar. This leads to a lack of rebalancing and extreme concentration in equity markets globally.
Are they just ignoring the signs? That sounds a bit reckless.
It does, doesn't it? This focus on price momentum might explain the disconnect between breadth and price. Many investors are overlooking breadth's warning signs. It's like being in a relationship where one partner is always happy, but the other is clearly unhappy. Eventually, that's going to catch up with you.
Haha, I love that. So what about the S&P 500? I heard there's a wider premium in the relationship between the index and the percentage of its stocks trading above their 200-day moving average. What's going on there?
Yes. Historically, those ratios have moved in sync, but we've seen periods, like in 1999 and from April 2023 to now, where divergences have persisted longer than usual. Both periods were characterized by generous liquidity from the Fed and Treasury. It's like a party where everyone's invited, but only a few are dancing eventually. That can lead to a very awkward situation.
So, is this a sign that something big is about to happen?
Potentially. The wider spread began when the U.S. $2.5 trillion reverse repo facility peaked in April 2023, coinciding with a U.S. $500 billion injection of reserves following regional bank failures. The key question now is whether draining the RRP and potential Fed cuts will tighten liquidity and close this spread.
Wow, that's a lot of money. So, if liquidity stays strong, does that mean this anomaly between breadth and price could stick around?
Exactly. If liquidity remains strong, we might see that disconnect persist. However, breadth may be less significant for high-quality indices with strong price momentum. Recent stock price resets indicate that expensive growth stocks and low-quality cyclicals are particularly vulnerable to higher interest rates and reduced liquidity.
So it's like the fancy restaurants that are always packed, but if the economy takes a hit, they might be the first to close down, right?
Spot on. It's all about understanding the underlying dynamics. So, keep an eye on breadth, folks. It might just save you from a market hangover down the line.
I'll definitely remember that. Thanks for breaking it down.